Oliver is 25 years old. He's been working hard for the last 6 years. He's built up a bit of savings by living modestly, budgeting carefully, and staying consistent. He's done everything right, and yet, something doesn't feel right. Every month, Oliver logs into his online banking app to check his savings balance. It's barely moved. A few dollars in interest monthly, and an insignificant amount after some years. That's it. It's frustrating. He's been disciplined, patient, and cautious, but the results, not inspiring. And as he sits there one quiet evening, staring at his balance, a thought hits him. Have I ever heard of anyone becoming wealthy from the savings account? He thinks harder. All the success stories he's ever read about, none of them start with, and then I left my money in the bank and watched it grow. No, they built businesses, they bought real estate, or they invested. Oliver realizes something important. Saving accounts are great for day-to-day spending, but they're not built for wealth building. Banks use this money to go out and make bigger returns for themselves. They lend it out, invest it, and earn from it. Meanwhile, he earns less than inflation. That means over time, his money is actually losing value, not growing. That realization is the spark. If banks aren't the place to grow your wealth, then what is? That's when Oliver remembers a podcast clip he once overheard. Someone mentioned the words shares. Shares, stocks, the share market, all the same thing. He's heard the words before, but never really paid too much attention. It all seemed too complicated, too risky, too financy. But now he's interested. Now he wants answers. So he digs a little deeper, and what he discovers starts to change everything. Let's break it down, just like Oliver did. A share is simply a piece of a company. When a company becomes publicly listed on a stock exchange, like Nike, Apple, or Costco, it divides itself into many parts called shares. When you buy a share, you're buying a small piece of ownership in that business. And no, you don't need to be a millionaire to own a part of Nike. You can start with just enough to buy one share. Let's be honest, most people will never have enough money to buy an entire company outright. You're not going to walk into Costco headquarters with a suitcase and say, I'll take it. But the share market gives ordinary people the opportunity to invest in great businesses. Even with small amounts of money, you can own a fraction of the biggest and most successful companies in the world. You become a partial owner, not just a customer. And why does that matter? Because when those companies grow, you benefit. There are two key ways that happens: capital growth and dividends. Let's talk about capital growth first. As a company becomes more valuable over time, maybe because of better sales, expansion, or smart leadership, its share prices generally increases. So if Oliver buys a share of Nike at $100, and a few years later, that same share is worth $150, he's now just made a profit of $50. That's called a capital gain. That's one way share investors grow their wealth, by holding on to companies that increases value over time. Now let's talk about dividends. Some companies choose to take a portion of their profits and give it back to shareholders in the form of dividends. Think of it like a reward for being part of their team. It's the company saying, thank you for believing us. Here's your share of the profits. Not all companies pay dividends. Some reinvest their profits to grow faster, but many reliable, mature companies do. And those dividend payments can be a steady stream of income. Oliver learns that many investors reinvest those dividends back into buying more shares, creating a snowball effect over time, known as compound growth. And this is where things really click for him. If he just leaves his money in a bank account, it sits there, slowly, safely, but it doesn't work. But if he invests his money in the share market, he can put that money into work. It's like planting a seed. It might not become a forest overnight, but with time, patience, and the right care, it can grow into something meaningful. Oliver also learns about diversification. Instead of buying shares in just one company, smart investors spread their money across multiple businesses and industries. That way, if one company has a bad year, the others may still do well and balance things out. Risk is real. Oliver learns that. The share market can go up and it can go down. That's part of the deal. But historically, over long periods, markets tend to trend upwards. And with the right mindset, long-term, consistent, and diversified, the risk becomes manageable. In fact, over decades, the share market has been one of the best ways to build real wealth. No gambling, no day trading, just steady intentional investing in great companies. For the first time, Oliver feels empowered. This isn't some mysterious world reserved for Wall Street bankers or millionaires. It's accessible, it's understandable, and it's something he can start doing right now. Oliver stumbles across a simple but powerful statistic. The S&P 500, a group of 500 of the largest US companies, has never gone down over any 20-year period in its history. Since it began in 1957, it has delivered long-term growth, despite short-term ups and downs, economic crises, and global events. This is the moment it all makes sense. It's not about timing the market, it's about time in the market. Trying to jump in and out of the market, chasing highs and lows, rarely works. But staying invested in quality companies over the long run, that's how wealth is built. If you enjoyed this video, make sure to click on the video on the screen right now. It's about how to spend your money, and it's a way that you can build up funds to actually fund your short-term and long-term share investing.